Before we dive in, a brief but important disclaimer. Made in Japan is an independent podcast co-hosted by Made in Japan and Ben Finzer, a portfolio manager at Fin Capital Management. Everything you hear on this show, including all opinions, analysis, and guest commentary, is provided solely for informational and educational purposes. Nothing on this podcast constitutes investment advice, a solicitation, or a recommendation to buy or sell any security or financial instrument. The views expressed by any host or guest are entirely their own and do not represent the positions, strategies, or views of Made in Japan or Fin Capital Management, its affiliates, its funds, or its investors. Investing carries risk, including the possible loss of principal. Past performance is not indicative of future results. Please consult a qualified financial advisor before making any investment decision. And with that, let's get into it.
One of the reasons why I wanted to interview you was because it's been a really incredible story for you to launch this Japan fund years ago without having really visited Japan at that point. My question was, how did you come to realize about the opportunity and what made you go all in on Japan?
Good question. Before 2013, we never invested in Japan. It seems like it doesn't make sense. In fact, some say, okay, if it's a risky decision, I always say it could seem risky, but it's the easiest decision in my life. If you have more than 25 years as a professional, if you are not capable of identifying a historic investment opportunity, perhaps you are not as good as you thought. It's the easiest decision because it's the biggest opportunity. I always say it's just once in a generation opportunity. Now it's easy to say because we launched in 2016 our Japan Deep Value Fund, but the perfect point is probably 2012, 2013. Of course, if you try it before, it's a terrible mistake. If you begin to invest in Japan 1997, 98, 2001 is a terrible mistake. We always like to filter and try to understand valuations in countries, in sectors. For us, it helps a lot to understand the dynamics, the cycles in valuations in the markets. I think there is no other country in the world with more negative feelings than in Japan, continuously. Even today, you saw continuously bad feelings about Japan. Japan market has problems, demography, public debt, etc. Now is the bond market. At the time, I thought it's not interesting investing in Japan because the country is not growing. But at the end, if you are a professional, you know that the best opportunities are when nobody thinks about it. We began to do filters. We analyze quickly all the companies in a market. We began to understand if it's expensive, it's cheap, or it's growing. In 2013, we began to find very, very interesting companies. We are not sure that could be real because it's very rare. We began to invest in 3-4 names. From Koala Capital CCAP is a mixed mutual fund that we manage. It's the first vehicle that we launched. After 2 years of see that there is a lot of interesting companies, in 2015, we go in depth. In 2015, we find even more companies, even more interesting than the companies that we bought. We began to share with our clients, our investors. One of them say, okay, that's very, very interesting. I want to understand what you could find in Japan. We have a lot of meetings with Japanese investors, with brokers. There is a moment you say, okay, that's incredible. We have to launch a fund. One of our big clients put the money to begin, only 3 million euros in Spain. We launched and only with family, friends, clients, we arrived to 7-8 million euros. We didn't communicate our decision to nobody because it's not easy to understand. We never invested in Japan before. And 2016 is a spectacular moment. Our portfolio of 35 companies, the average EBITDA is about 2 times. Of course, there are small caps and micro caps. We find that big companies are not extremely cheap. Mid companies are better. Small caps, there are a lot of opportunities, but in micro caps, that's incredible. We saw that the critical point is about English and brokers research. In all the companies that we select, there is no English information and there is no brokers research in English, of course, and probably not in Japanese. That's the key because the difference in valuation with smaller mid caps with English information is probably about 8 times multiple, 8 times earnings or EBITDA or free cash flow. But if you don't have English information and no research, is about 2 times, 1 time. After more than 1 year working hard to translate from Japanese to English for about 50, 60 companies. All the Japanese companies, as you know, they have investments in suppliers and clients. So if this company has 1 century in the market, even 50 years in the market, they have a very good portfolio of shares. That could be about 10% of market cap. You have to include in cash. Our calculation of enterprise value is cash plus liquid financial assets at a daily valuation. Also, we find there is a lot of real estate. Companies are 2 times multiple, and also they have real estate at cost. That could be a plant or headquarters, etc. So this is the moment that we saw that is a big opportunity in a generation.
Again, it's just pretty incredible that you started from Barcelona and straight into Japan. There's some cultural differences. So what were the initial challenges there and how did you try and overcome those?
Well, okay, this is the challenge I think we will never solve, because I think Western guys and Japanese society, I think we never will understand exactly all the aspects. First of all, we had in these past years about 13 Japanese in our team, because we have an agreement with the famous MBA in Barcelona, or 2 MBAs, IS and ESADE, and we have MBAs for 6 months coming from Nomura, from Daiwa, from Morgan Stanley in Tokyo. That helps a lot. It helps a lot to understand the products, because there are a lot of products in Japan that are completely different than in Western countries. You never know how is possible this product has a success in Japan, because in Europe it's impossible to know. But I think there is one point that is critical, is the accountants. I think accountancy is very reliable. That's helped a lot, because the Japanese accounting system, it's for me the most credible in the world. First of all, because Japanese are very conservative, and after a crisis of 20, 30 years, they are even more conservative. All is at cost, and obviously it aligns with international standards. That's very, very relevant. But when you analyze the accounting system, you know that the same profit in US, $100 of profits in US corresponds to $120 in Japan, because in terms of consolidation, in terms of policies of products at cost, the earnings in accountancy are far lower in Japan than in US for the same company. That's very important. We didn't invest in China because we don't have experience in China, but we are not sure that all the accountancy system in China is as good as in Japan. Investing from Barcelona, that's a critical point. Probably without that, I don't know if we could launch it, because if you doesn't trust in the accountancy in a country, and investing from abroad, I think is not possible.
In the early days when you were investing in a few Japanese positions, were there clear differences between the portfolios you managed in the Japan fund?
Our analysis of ratios and strategy is the same in all the countries in the world. For us, free cash flow is key. And in Japan, probably the only difference between the rest of the world is the working capital is very volatile. That's for us, that's probably the only point that is more complicated to understand and to find why the working capital is so volatile. In the rest of the world, usually is not volatile. That's a very important issue. For that reason, we adjust a little bit free cash flow generation before working capital, because that's interesting to compare companies. But in terms of the accounting system, it's better because all is at cost. Recently, there is a company in Japan that sold a big building or land in the center of Tokyo, and the price, it's incredible because it's a price in the accountancy of 100 years ago. That's impossible to find. The North American management is very, very aggressive. The European ones are in the middle, but for sure the more conservative are Japanese. The good point is the analysis is the same in terms of ratios, but only adjusting this. There is also a small difference in some specific sectors, but it's not relevant.
Going back to that period when you were screening the market and Japan stood out as a glaring opportunity for you. I'm curious how you made sense of the low valuations, because I'm assuming your first reaction was, wow, a stock trading on 2 times might be a fraud. This company going out of business, there might be something really wrong here. After seeing enough of these companies, how did you rationalize that low valuation for so many companies in Japan?
Yeah, this question is key because, as you know, there is no free lunch. There is no free lunch in the market. So when you find in London or in US a company that's 2 times EBITDA, is because there is a fraud or there is a big passive asset. So there is something that will be terrible, and you will see in the next year if you invest. Our first idea is that's not possible, but it's important to have experience in markets because, of course, only in Japan there is a bear market of 25 years. I think, well, it's 20 years because we could say clearly that in 2012 the market cycle changed. It's from 1989, 30th of December, until 2012. It's 22 years of bear market. There is no people in the world who have had experience in a bear market of more than 20 years, except in Japan. In terms of valuations, when you read books about the crash of 1929, is the same valuation of the US market in the year 32, 33. The multiples are 3-4 times for the US market. That's incredible. That's the best moment in the history for investing in US market. Also, John Templeton invested in Japan in the 60s. And I think it's interesting. I have just the text that we put in our quarterly report and we sent to investors. Michael Lipper, the founder of the fund analysis firm Lipper Associates, he said, John Templeton, Warren Buffett, and George Soros are the 3 most legendary investors he has seen in his professional career. According to Lipper, they all share one common trait, the personal solitary conviction to make investments that most people don't understand. Because John Templeton was a pioneer in international investing, particularly through his investments in Japan. In the early 60s, Japanese stocks traded at a multiple of price to earning of only 3 to 4 times, while US stocks traded at multiple 4 times higher. It's about 18, 20 times, 21 times. And he decided to invest about 60% of the portfolio in Japan. 20 years of investment at 3-4 times. And the stock market in US is not going well because the crisis of the 70s and inflation and interest rates at 17%. He could sell the Japan stocks in the 80s, several years before the top, because it's impossible to find the top because the bubble in Japan in the 80s was the biggest in the last century. He kept the Japanese stocks and he could invest in North American companies. He has the best performance ever for 20 years. So this reminds me a lot about the situation in Japan in small caps. In this moment is for all these Japanese stocks. Of course, now the big companies doesn't have these multiples. So it's only about a niche in small caps and especially the micro caps. What we find is that Japanese are very pessimistic. Probably a lot of people say, Mark, how is possible that if you are not Japanese, how you could invest? We said, I think in this case, in this period, it's better not to be Japanese because all the Japanese that we talk, they are very, very pessimistic after 20 years of deflation. For us, it's very easy. We are Western guys. We compare Spanish, we compare French companies, North American companies with the Japanese ones. And when you saw the difference, the same company, the same sales, the same margins, you could find hundreds of examples. And in Japan, you could find that 3 times free cash flow, and in US at 25. The flows are key. All the people exited Japan. Even all the index in Asia is ex-Japan. That means that all the flows are going against Japan stocks. So nobody invests. In fact, the insurance companies in Japan are continuing to sell shares. Even today, there's about 20 years selling shares, probably because of regulation, but also is because the cycle is negative. So it's perfect. When all the people are selling, is the best moment to find the best opportunities. Not opportunities for 1 year or 2, but opportunities for 10 or 20 years. The next 10 years could be also very positive.
You're about to hit your 10-year anniversary since the launch of your fund next year, which is extremely exciting. My question here was, in what ways do you think your views about the Japanese markets changed over the last 10 years? From your initial expectation of how things are going to play out, what perspectives have changed for you?
There is a radical change since 2023. That's the most important moment. When we invest, it's a market with no catalyst. Okay, so it's easy to invest at 2 times. There is a moment in 2022 that 20% of our portfolio are companies with more net cash than market cap. But 2023, it changed completely. Abenomics is the first moment in 2012. In terms of governance, I think it's very positive, but it goes slowly. And in 2023, first of all, it arrived Warren Buffett in 2019, and they began to invest. And in 2020, they publish a letter. They say, okay, for first time in our life, we are investing in Japan. And since then, they are buying shares in Japan each quarter until today. Even the last quarter, they are selling US companies and they are buying Japanese companies. But Warren Buffett is very important for Western investors, but it's not relevant for Japanese. The key in Japan is in 2023, Hiromi Yamaji arrived as the new chairman of the Tokyo Stock Exchange. That's the biggest revolution that we find since we are investing in 2016. And only arriving as a chairman, they send letters to companies with price to book lower than 1. And it's very interesting because it's not an obligation, but they say, okay, if the investors doesn't pay even your book value, you don't have the trust of the investors. So what's the problem? What you will do for improve the situation? And at this moment, if you analyze our net asset value in our fund from the beginning of 2023, you will see what's the effect in the company shares. They sent an obligation to publish in English. The obligation is, if you want to stay in the topics index, you need to publish in English. We explained several years ago in an interview with Bloomberg and with Nikkei that probably a simple issue of publish in English will attract a lot of investors because all the professional investors all over the world didn't invest in a company without English information because you never know. So he begins to change a lot of things. The next letter was, okay, I want you to give us the return on invested capital of your company and the cost of capital. And after that, they begin to share a lot of examples of companies explaining about these calculations. In fact, now in China or in South Korea, the regulators are in some aspects copying the strategy of Hiromi Yamaji. No? Hiromi is a former responsible of Nomura in London and in New York. That's very important to understand the global markets. And he understands, of course, the mentality of the Japanese management and owners. They say to the companies that they need an investor relations. The most incredible part is when we began to invest, there is no investor relations in any company that we invest. That's unique in the world. After Hiromi arrived in 2023, there is obligation to have an investor relations and to demonstrate that they have meetings, especially with international investors. Since 2023, we have meetings each year with all the companies that we invest and other companies that we are looking for. That's a big change. But not only to have the meeting, in the past, these meetings are not interesting because the answers are not good, are very political, but now they are answering our questions. They are answering about segments, about profitability for segments. Now there is a lot of new possibilities in terms of improving, for instance, the buybacks in 2024, the year after Hiromi arrives, the buybacks was double that 2023. It's a big change. Also, the increase in dividends here are big, but especially in buybacks. Now, buybacks and dividends are about 70% of earnings. When we began, probably it's about 30%.
I just wanted to go a little bit deeper into your investment process as well, because during the time you launched, you were much more focused on deep value companies. Things are extremely cheap and cash rich. Today, I've noticed that you've shifted a little bit more towards certain growth companies in your top 5 holdings. For example, I see companies like Integral, which is a private equity business. I would definitely categorize that more as a growth companies. How did that evolution happen?
Good point, because it is a mix of two aspects, an internal process and an external one. When we launched in 2016, we didn't have experience in Japan. We prefer boring companies. There's supermarkets, it's construction companies, industrial ones. We prefer to acquire only this type of companies and 2 times EV free cash flow or 1.5 times EV EBITDA. It's easy to find double-digit performance in 10 years. So this is the first period. And in 2021, we began to include other companies with a more profile of growth companies for 2 reasons. First of all, we had more experience in Japan, no? It's about 6 or 7 years investing and understanding, talking with our Japanese guys in our team. We are, I think, more prepared, but basically in 2021, there is a top in the growth companies in Japan and globally. After 2021, even the Japanese companies in the technology sector begin to go down until 2024. Okay, it's about 3 years of bear market in technology stocks. We find a lot of opportunities are growing double digit. Sales and more in earnings. Probably it's about 10% in sales, but 15 to 20% increase in earning per share. We begin to find in our filters companies with 7 times EV free cash flow, but growing at 12%. That's even better than to have 2 times multiple growing at 2, 3, 4%. We decide to begin to invest, and now we have about 23% of our portfolio is growth companies, and the 75% is boring companies. We are very flexible. We don't know in the next 2, 3, 4 years. It depends on valuations. But I think it's a good idea to include some growth companies because the cycles are completely different. We have Shinihon Corporation, a construction company, until 2022, flat for 5 years. And with growth companies, in this period, it combines very well in the portfolio of companies of different sectors and different styles.
And I think it's pretty incredible because a lot of the struggles that some fund managers have when they're very focused into deep value companies, they're anchored to depressed prices of 2 times cash flow or 3 times EBITDA. And on the other side, growth companies may actually look in that context a little bit more expensive, like 7 times or 10 times free cash flow. And that makes it very difficult psychologically for a lot of investors. And that's why I would say it's probably on the rarer side to see people who are able to do both. How do you overcome that psychological barrier within your fund?
Good point. Of course, as you would imagine, we are very flexible because launch a Japanese fund without any experience in the past is not easy. We are an independent asset manager. It helps a lot to don't have the pressure of the clients. That's the first point. The second one is, of course, it's more difficult to invest in growth companies than in value companies. I think it's very difficult or very rare if we will see in the next years that we have more than 50% in growth companies. But I think the logic is to have less than 30% in growth companies. But also we are including other styles that I think is very interesting. First of all, is Integral Corporation, as you mentioned, is more a growth stock, but it's an asset manager of private equity in Japan. So in this new period in Japan, one of the key elements is that now the big private equities, the North American and European ones, are arriving in Japan in the last 5 years. So probably is the best market in the world to invest in private equity in Japan. Now, probably not in 2016 because there is no catalyst, there is no openness in the management, in the owners, but now is the moment. So we also find companies like Integral that is growth, but is more about a new style as a company that are consolidating sectors, investing in companies usually not listed. And also we have in the portfolio some companies that are beginning to do M&A. That's completely new in Japan. We have 1 or 2 companies, in fact 2 companies in the portfolio that are active acquiring companies in his sector. And that's what we saw in US and Europe in the last 50 years. So I think it's another category that we want to increase and to have about 10% or 15% of our portfolio of this type of consolidators. We are looking continuously, but we have 2 companies plus Integral.
On Integral, if you're willing to use that as an interesting case study, both to discuss the opportunity, but also your due diligence that helped you get comfortable investing in a company like that other investors might view more as a black box and got you across the finish line.
I think the best quality of Integral, as you said, it's a small team. They began just post Lehman Brothers. They began to invest in 2010. They are doing it slowly, and that's the best element to improve in a sector, to go slowly, to invest in companies, have experience, to launch a small fund, a second small to medium, a medium fund, and the January 25 fund is near 3 times bigger than the last one. And I think now they are in the best moment for growth because overseas investors and also pension funds are not very active yet in investing in private equity in Japan. They will capture this. I think it's clear because they are Japanese and they have a good experience in private equity in Japan. So I think in our vision, it's a perfect fit in our portfolio because they invest in private companies and we invest in public ones. It fits a lot and it's the same strategy. It's a strategy of investing in Japan because there are a lot of opportunities and for 10 or 20 years. We have 2 or 3 meetings with them and they are very, very good. In English, it's easy to understand all the dynamics. For us, it's top 5 in the portfolio because I think it's the only asset management listed in the Tokyo Stock Exchange in private equity.
To shift back to the value positions that you have in Japan, there are so many value traps as well. Companies that screen extremely cheap but then it's difficult to realize that value over time. So how you avoid the value trap and whether there are specific guardrails that you've implemented, companies that you specifically avoid, or any characteristics that you look for within these cheaper companies.
Yes, absolutely. We said that Japan is the best market in the world and also most risky in terms of value traps. The first element is valuation, and the second element is the evolution of the business. We sell some initial investments that are very, very cheap, but they are not improving. So I think in the first when we began in 2016, we have about probably 10 companies. The valuation is incredibly cheap, but they are not improving. Even sales begin to go down a little bit. We sold them, majority with some profits, but it's not a good investment because if you earn 10% in 3 to 4 years in Japan, that's a very, very bad result. But is not a real value trap that you invest, you lose 50%. Of course, there is a lot of technical analysis in Japan. That's the more surprising issue that we find at the beginning. And when we talk with professional investors in Japan, we always say, okay, really, it's technical analysis so important in Japan. And you saw this because the difference in valuations, it means that there is a lot of analysis that is not fundamental analysis. And could be technical analysis or could be other aspects like to give gifts to shareholders. You give dividend of 2% plus you send the products of your food company to shareholders. There is a lot of people investing in this company only for these aspects. The valuation is very expensive. So there are a lot of elements. If you talk to them, you saw if it's interesting to invest.
It's a great lesson in incremental buyers in a market like Japan, where your incremental buyers might not necessarily be institutional investors, but individuals who are seeking certain shareholder gifts or, like you said, momentum. Do you take this into account to avoid your cheap company being a value trap? If so, how do you think about it, if at all?
After 2023, we find some momentums when there is some events in Japanese companies. For instance, in Japan, you must buy minimum 100 shares. Okay, that's important because there are a lot of small caps that they didn't receive investments from individual investors because 100 shares is too much. So now momentum arise when a company with a good numbers, and if it's a good company, it's interesting. When they announce buybacks, that's the first point, and there is a lot of momentum when company announce buybacks. And the second one is split. The companies that now announcing splits, especially if there are small companies. In fact, we have Fukuda Corporation. It's a boring company that we have in the last years, and it's completely flat. And this summer announced an improvement in the liquidity of the company, not for a split. They decide to sell shares from the biggest investors. The free float increases. Only with this decision in summer, the price goes up 40%. So now only with the splits, with buybacks and decisions to improve liquidity of the small caps, that has a lot of momentum. Now we are focused on these elements because it means the management are aligned with investors, because the risk is to have a very conservative company without changing. There is a big change in these 10 years from stakeholders in the center of the company, and now is more shareholders. For that reason, now it's better moment for investing in Japan now than 10 years ago.
What do you think about shareholder gifts and the existence of it? Obviously, this is a controversial topic when speaking to international investors versus domestic.
I think it's not positive. Probably it's more about what they said about the stakeholders, because you take a decision only for the gift, not because the company is well managed. I think it's not positive because it doesn't help to improve the management, because for the management it's easy. You do the gift and nobody cares, but I think it will be changed slowly, probably. Compare to use this fund of gifts to do buybacks. If the company is cheap, the effect is far better because the company price will go up and all your shareholders will receive a very good performance. So that's my point.
Your portfolio composition is extremely unique across different Japan-focused funds. I'd like to understand, how do you find these new ideas? What are the main criteria that you look for? Do you use any unusual metrics to find these businesses?
It's easy to find interesting opportunities in Japan. We do the same that we do in US or in Europe. It's about filters of free cash flow. We calculate 5 to 6 different free cash flows because we adjust several issues. I think that's important for us. And in Japan, you have to adjust the working capital because if not, it's difficult to compare. But it's about free cash flow. But each time for us, it's near top one is return on invested capital, especially in Japan. So it's your incremental profitability. That's important because the ROICs are very good in Japan. Return on equity are not good because there is no debt in the companies in Japan. Return on equity is far lower than the US companies that have a lot of debt. But in terms of return on invested capital, in fact, you could say are at the same level or even better the Japanese one, because with a small investment, you have a lot of good profitability of the company because your costs are very low, you have a lot of capacity. So the translation of sales to earnings is very good. It means that usually the ROICs are high. We have several companies with less than 10% of ROIC. And after several years, we saw that companies with less than 10% ROIC are not good business. Now, for us, return on invested capital, we think is the most important, probably the most important element in all the countries, but especially in Japan.
When it comes to research, you've built an AI platform to aid your research, to pull through Japanese filings. Tell us a little bit more about that research process that you have, and especially with your team of Japanese students from IESE.
Yeah, so obviously in 80% of our portfolio, we don't have any Japanese broker who could explain us. We only have the public filings. It's important our Japanese guys search for Japanese information and to create a report in English. We have reports in each company in English, but the majority are by Japanese people. So that's very important because they understand better the products. They could talk about colleagues about why this product is successful in Japan. And especially it's very important to compare one company with another because it's most difficult for us to understand which is the real competitor. The good point is there is a lot of listed companies in Japan. When we saw the competitors, probably 2 or 3 or 4 are listed companies. We have all the numbers, and that's the key because we could compare margins, growth, etc. And we find in Japan, it's like in the US 50 years ago. There are a lot of companies that are focused on a region in Japan, in the north of Tokyo or in the south of Japan. So there are companies doing the same, but with a regional influence. So it helps to find a lot of companies, compare which is the best one. And for that reason also, we are thinking to invest in consolidators because it will arrive in Japan probably slowly that in US, but it will arrive.
To the extent that you can share, what are potential consolidators in your portfolio right now?
Yes, we have sharing technology and we have Saigen. It's 3679. And Saigen, it's difficult to pronounce it because you will see the name. The code is 3679. So both are consolidating. Sharing technology, especially a small company, but we like because the CEO has 5% of the company, and this is not usual in Japan. So they have the right incentives to do a good job and consolidate the sector. So that's another point that is not easy to find in Japan. Usually the management has no real high performance salary that could change his incentives. They are always very small, even as a fixed salary. The salaries in Japan probably it's 15 times lower than the US one. Imagine in sharing technology, it's a very niche product, very small company, but I think it's well prepared. They are doing very well. We will see because when you acquire companies, you have to analyze continuously the new company that they acquire and the valuation. Until now, we are very happy, but we'll see. We hope we could maintain for the next 10 or 20 years in these two companies. They have a lot of experience doing M&A. That's important because you need experience in doing M&A for improve in the future. And nobody in Japan is acquiring other companies. It's not common. We are trying to find more companies like this because I think this will be our next category.
I'd like to ask more about one of your top holdings, Tsubakimoto Kogyo. Walk us through what the opportunity is and why it continues to be a large holding for you.
This case, I think we invested in 2019. We didn't find it at the beginning, probably because in 2016 margins are terrible because it's a trading company of industrial machinery. It's founded in Osaka in 1916, so it's more than 1 century, as a company. And they are very good, especially in power machinery, industrial machinery, etc. And they are improving the mix of the products. And we discovered in 2019 because the margins are improving continuously. And if you analyze the margins in the last 7-8 years, they are going from 1% of net margin to sales because it's a trading company, and now it's 5%. Increased by 5 the margins. Of course, the return on invested capital, I think it's about 20% because you have a lot of rotation because you sell machinery, you have very good technicians, and especially you have very good relations with your clients for more than a century. So clients are big companies. That's very important, because if your clients are small ones and there is a change in the small company or someone acquire this company, you could lose the client. His clients are the big company, which means that probably they will maintain clients for the next 10 years. And they have cash in the bank and holdings in equities more than the market cap. More or less, they have the same level now. You buy for free and they are growing more than 5%. So it's a perfect company. A boring company, nobody analyze the sector because it's very Japanese. Trading companies outside Japan is not easy to understand. For us, we need some time at the beginning to understand the logic of trading companies. Of course, Warren Buffett invests in the big ones, or the big 5 trading companies. So it's a trading company, but a small one, different from the other 5, and is unique because it doesn't exist in general in other countries. Trading companies, they have a lot of importance. They are very relevant in Japan, but you have to understand the historical relationship between good familiar groups and its relation. The big difference to invest in Japan to Europe and US is that when you have a good relationship with a client, it's for the long term. In the Western countries, you could change tomorrow your supplier if the service or price is not good, especially the price. In Japan, if you have a client for 50 years, it's very difficult to lose. In fact, you will continue for sure, and that's important. And for that reason, the trading companies are very relevant in Japan because they are at the center of a lot of things. No? Of course, Mitsubishi Corporation, Mitsui, others are more important, but Subakimoto Kogyo is a very niche company, and they go up probably 50% in the last year or last year and a half, and you pay only for the cash they have. So probably valuation has to be 2-3 times or 4 bigger.
You mentioned earlier that a change in your process has been having conversations with companies because the information is just more relevant and meaningful today than it was in the past. But I'm curious if you've also used these conversations as opportunities to engage with management teams and maybe give them suggestions or encouragement, or whether your investment thesis really relies on this change that's sweeping across Japan and the reforms at the Tokyo Stock Exchange as a way to catalyze that valuation realization.
Yes, our surprise is that we find easy to engage with them. Probably it's because of this change from the mentality, because of the president of the Tokyo Stock Exchange. Because in the past, as a foreigners, it's impossible to have a very good relationship with management. In some cases, we do a lot of engagement. It depends on the company, but they are more open than in the past. And we are now pushing all the companies to improve liquidity, for instance, to do splits if the price is too much high. And of course, do buybacks, but buyback is different because you need to spend money. It's a more difficult decision, but especially in simple decisions, we send other examples in our portfolio to the management to analyze if it's possible to do it in his company, because with only small change, like improve liquidity of the share, the free float, or doing a split, the shares will go up without changing nothing strategic in the company. So in general, I think 60-70% of the cases are very positive in terms of our dialogue with them. With only 10%, we don't like what we saw. We try to push and engage with them, and it's not easy. There is 1 or 2 companies that we are selling now because of that, but in general are more positive than we thought. So it's clear that the Japanese, they changed the mentality, probably because of Hiromi Yamaji, I think, because there is no other aspect recently. I could imagine that is for that reason.
On portfolio construction, I'm curious how you arrived at 45 to 50 companies as the optimal size, because there are funds that have over 100 and then funds that are even more concentrated.
Yeah. For investing in a company, we analyze all the aspects that I explained. So it's easy to find 50 companies because they're more cheaper and they are improving, good ROICs, and the evaluation to sales growth is good. The size, of course, is a question of liquidity. We have some companies that are very interesting, but we have only 1% of our portfolio because the liquidity is lower. But especially our top positions is companies that are having good ROIC, obviously a good valuation. That's of course the most important. But if they decide to do buybacks in August 2024, when there is a big fall in the Japanese stock market, in an extraordinary meeting of the board, that means a lot. That means that they are more focused on shareholders. And now, if they are doing a split, it's perfect. If they are increasing buybacks, doing a split, have a high ROIC, and if we talk with them, they are open and they want to improve, that's clear. Our top companies. There is some elements that we had helped to increase the size of our investment.
And your sell discipline, is that primarily focused on a target valuation, or it'd be helpful to understand what makes you decide to sell a position?
When we buy a share, we don't say, okay, if the price arrives from 100 to 300, we will sell, because obviously when it arrives at 300, we have to analyze the numbers of the company. Our key element is the valuation, and sometimes the market is very optimistic. It's not easy in Japan, but we find there is some examples in our portfolio. We sell partially or completely if there is a lot of optimism in the share and the price is going up by 3 or 4 times. The valuation is 25 times, but we saw a lot of opportunities. We decide to sell and look for another opportunity. But as we always know, it's easy to buy, it's more difficult to sell. Now it's a less complicated decision, because if we sell a position, we have a lot of opportunities to invest. But in the future, when the valuations are more logical in Japan, the decision will be more difficult, because when you sell a company that is doing well, you have to invest in another one that probably don't have catalyst in the short term, and it's not easy to when to sell. But now it's more easy because we have plenty of opportunities. It's not so risky to sell a share at 20 times multiple, find a company with 3 to 4 times multiple.
Thank you. Final few questions, and really closing out the conversation on how big changes have been happening in Japan since 2023. What do you see coming for Japan in the next 10 years, and how do you see things evolve going forward?
Of course, Japan always will be different than the rest of the countries, because Japan society is unique, is very different in all the aspects. But of course, in terms of financial markets, what we saw in US, in Europe, even partially in Asia, the process of consolidation, the process of improving or increase buybacks, the process of acquire a company as a competitor. You have a lot of cash because you are the best to understand if you are interested to acquire your best competitor, or they have a very good asset or very good clients. So all these aspects, it appeared in US 50, 60 years ago, and in Europe probably 30, 40 years ago. The logic is it arrived in Japan. Even Japan being a country that's different, I think we will see a lot of M&A, more private equity, of course, improvement in capital allocation because they have a lot of cash, beginning to take debt slowly, I think in the next 5 years, because after a big crisis, all the family business, they reduce the debt to zero. Probably the next generation that they didn't remember the 80s, they could begin to take some debt. I think it's positive to take some debt, not a lot. We will see more debt in the companies, more investments, more projects, more capex. I think the key is to have more capex. I think this is the key of Abenomics. They want to improve investments, more capex of each company. It means more sales to the rest of the companies. It means more salaries for people. And I think this is what we will see in the next 10 to 15 years or 20 years, depending on the velocity. We will see at minimum 10 years, because in Japan, sometimes the change are going slowly, no? That in US.
To close this conversation, I've had a lot of readers and listeners of Made in Japan wanting to or are planning to visit Japan. So I always like to share a few favorite places or experiences or little things about Japan that many people might not know. So our closing question to you is, what's something about Japan that you wish more people knew about?
I always recommend visit Japan, because from the breakfast in the morning until the dinner, you discover completely different situations that you never could imagine. That's the best for visiting Japan. For me, I love Hokkaido. When I visit Hokkaido, it's really different. But of course, if you visit Japan for 1 week or for 2 weeks, it's not possible to go to Hokkaido. It's only recommendation for a trip of minimum 3 weeks, because Hokkaido is in the north and it's a very rural area. And also Nagasaki. I love Nagasaki. So it's a beautiful city. And it's completely in the south. So I visited in the same trip Hokkaido and Nagasaki. It's spectacular.
This has been amazing. Thank you so much for your time, Mark. We've learned a lot from you today, and we're looking forward to our next conversation.
We stay in contact. Thank you.